Well, we're dealing with Japan, we're dealing with South Korea, we're dealing with a lot of them. We're dealing with about 15 countries, but as you know, we have about 150 plus, and you can't do that. So we're going to be sending letters out in about a week and a half, 2 weeks, to countries, telling them what the deal is, like I did with EU.
World leaders better keep an eye on their mailboxes, as President Trump says they'll soon be getting written notification of tariff rates. The latest threat coming just a day after Chinese and U.S. officials took down their trade tensions. Live from Singapore, this is Insight with Haslinda Amin. Now, those comments from Donald Trump hitting the dollar and U.S. futures and sending haven assets such as treasuries and gold higher. Earlier, the president said China has agreed to supply magnets and rare earth metals, while the U.S. will drop threats to revoke the visas of Chinese students. Harvey, Kaye, Executive Director of U.S. Critical Materials, will joining us to discuss the huge leverage China has over Trump with its stranglehold on the supply of processed rare earths.
And the long-term theme that I think is one of the most bankable, and it might take in 30 years, this will be a great success, and that is you should invest in India.
Also ahead, DoubleLine's Jeffrey Gundlach tells us that India is the long-term bet for investors looking to move out of dollar-based assets. We'll get more on how and where global investors can put their money with Kotak Mahindra Bank President Gautami Gavankar. Welcome to Insight. Our top story today. President Trump says he's planning to send letters to trading partners within the next 2 weeks to set unilateral tariff rates. That's ahead of a July 9 deadline to reimpose higher duties on dozens of economies. His team continues to work on bilateral deals with key partners, including India, Japan, and South Korea. But when it comes to the biggest deal, Trump says Washington's framework trade agreement with Beijing is a done deal that will include upfront shipments of rare earth materials. China dominates the market for rare earths necessary for defense and EV production globally. It seemed to have gained the upper hand in trade negotiations after essentially shutting down exports of rare earth magnets. The relative calm in markets as trade tensions appeared to ease didn't last long. Trump's latest tariff comment is reigniting uncertainty. Stocks are down along with the dollar, and Avril Hong is here. And Avril, it's risk-off havens catching a bid, but not the dollar.
Yeah, it is definitely risk-off in the region, in U.S. futures today. I mean, it's this thing about the U.S. policy uncertainty that markets have just been grappling with already for much of this year, now reintroduced, re-emerging given these trade tensions and uncertainty. So we're seeing the U.S. futures are down along with some stocks in the Asia-Pacific. What is up? It's the VIX futures along with gold and the yen, highest levels in more than a week for some of them. And of course, this feels almost like that Trump-C phone call didn't happen. All in, investors are cautious. You get the sense that, there's also a layer of investor caution given the tensions in the Middle East, along with this coming ahead of the auction of 30-year bonds in the U.S. Now flip the board, because as you say, the dollar has certainly not been catching this safe haven bid. We've seen it falling by the most in about a week to the lowest level since July 2023. It's already 8% down this year, and we've already heard from the likes of Paul Tudor Jones seeing that this time next year he sees it 10% lower, and expecting as well a dramatic fall in short-term interest rates. All in, it feels as though when it comes to the dollar, whether it is good or bad news, good or bad data, that markets sell it. If you take a look at the US inflation print overnight as well, which similarly weighed on the dollar, we saw core CPI rising lower than forecast. This was for the fourth straight month. Now, it's worth noting that our colleagues at Bloomberg Intelligence don't see this as because of a lack of tariff pass-through. This, to them, seems more like being offset by deflation in areas including services. That's worth keeping an eye on. All in, Has, it feels as though this dollar frown is just getting worse.
Avril, thank you so much for that. So Trump says China has assured the supply of rare earth magnets, but the country's stranglehold on their production may give Beijing a huge leverage in future trade negotiations. Joining us now is Harvey, Kaye, Executive Director at U.S. Critical Minerals. It's a privately held rare earth exploration and development company with strategic holdings in Montana and Idaho. Good to have you with us. Would you say, Harvey, that the trade spat essentially is about rare earths, critical minerals, and it really is about supply chain warfare?
Actually, there are two elements to this, and you are exactly right, because this is an issue that has been going on for probably 20 years. The Chinese, to their credit, have used a long-term strategy, and many 15, 20 years ago, they dropped the price of rare earths substantially and made it easy for Western countries to get their supply and to be able to simply order and have it delivered. When it became a geopolitical issue, which is very recently, then it became a negotiating tactic, and the U.S. found itself kind of behind the scene, having basically not really developed internal infrastructure and the supply of rare earths that actually exists here. And so over the last, let's call it 8 or 9 months, the realization that is that in fact a negotiating lever and something that makes this country vulnerable has accelerated the interest and the opportunities for U.S.-based companies. To that end, our company, U.S. Critical Materials, has a deposit in Montana that is considered the highest grade rare earths ever found in America, ranging somewhere in the 9% range, which is extremely high. What has also been a Chinese advantage has been their ability to process. And even though some of the processing has been environmentally difficult, there's been a full court press to develop new, modern, cutting-edge technologies to process here. We are involved in both aspects of that. So
the thing is, Harvey, we have seen this play out before. Back in 2010, China did shut its exports of rare earths to Japan amid a fishing spat between the two nations. I'm just wondering why the world has not learned from this.
Well, that's the great question that you've asked. And the reality of it is we have. And the reason I say that we have is because under the current administration, they have passed executive orders. They have set up a fund in order to develop an offtake marketplace for U.S. producers so that the vulnerability to price manipulation is no longer what it was before. Once burned, shame on us. Twice burned, you can't allow that to happen again. So to that end...
Yet here we are, Harvey, yet here we are with China dominating rare earths, 70% of, if I understand it right, mining, 90% refining. Nobody comes close. How has China managed to do this? Is it about its Belt and Road Initiative where it's, looking for those supply chains outside of China as well?
Well, again, an excellent question. And the answer is, yes, the Belt and Road approach has been very successful. We have a 4-star general that is a retired general that is advising us. And in Africa, for example, all the mines are currently owned and controlled by the Chinese. We have allowed that to happen. Basically, I would say complacency. I would say it was easy because China made it easy. Now, there's this stark realization that it is, in fact, a political weapon. And obviously, this country realizes that they have to do everything they can to support the development of a domestic rare earth and rare earth processing infrastructure. To that end, there is full speed ahead. We are working with Idaho National Labs, which is one of the major national labs, to develop a new state-of-the-art processing technology, and we're moving along quite briskly at that. You put the money to it, you put know-how and ingenuity to it, and you put a realization that you have to do this because ultimately
Right.
it's a weapon we can't allow to just be that way. So it's happening. It's going to take some years, but it will happen.
Well, you say it's going to take some years. It's actually a lot of years. We're looking at perhaps 10, 15 years from now. In the meantime, as it stands now, isn't it true that China has the ability to basically shut down U.S. defense production, given that, it requires, if I understand it right, 12 critical minerals for defense, and China has control of them?
Actually, there's 17. Which includes rare earths and things like gallium and other materials like that, which we happen to have in very high grades and relatively easily available. Where, with deep respect, I would not agree with you. It's not 10 years. It's not 15 years. It didn't take that long, for the Manhattan Project or for anything where you put the money, the talent, and the focus on it to accomplish a goal. And we believe that it is 5 years. We expect that we will have the ability to start extracting and processing ore, including gallium, by the end of this year. And so the government is assisting in fast-tracking permitting. They're assisting in creating fail-safe markets so that price manipulation will not affect the industry, which is a benefit to U.S. critical materials. And there's a major effort to negate the situation that they're in right now. So I wouldn't count the USA out at the moment. I would say that there's a focus and a will to accomplish the goal that we've just spoken about.
How about other alternatives? Some talk about Ukraine, Greenland. How feasible are they?
Frankly, not so much. The reason for, and by the way, the amount of time that it would take for them to go online would be actually longer than it will take in the United States. And so Greenland, for example, talking about gallium, which is used in 3,800 military applications. And again, we have high grades of gallium, and we will expect to start processing it and making it available by the end of this year. Our percentages run 180 to 380 parts per million. Greenland is about 60 to 70 parts per million, and Ukraine is about the same. So the grade is low. The problems of actually mining it when one is in a war state country, the other is not having the infrastructure, and they're just not ready. And so it appears that we will be able to bring our domestic supplies and, most importantly, processing online before that occurs. But we encourage it. The more people, the more countries that are working on the process and extraction, it's good for everybody. And so, we want to be cooperative and we want to work with everybody.
This affects everybody, as you suggested. No minerals, no missiles. How about the likes of NATO and other U.S. allies? How are they approaching it? How are they protecting themselves? What are the efforts that you're seeing so far?
We are in communication with users of rare earth materials in Europe and in the United States. And they are looking for supply. And it's not that you need huge quantities. It's you need purity, you need availability, and you need it to be price competitive. We can do all three of those. So Europe is looking for supply. We are in discussions with certain automotive companies because critical minerals are incredibly necessary for the automotive industry. We are in discussions with chip manufacturers. They just announced the Stargate project here in the United States. That is multi-billions that are going to be put into artificial intelligence, chips, and the like. It all sounds good,
right,
but if you don't have the supply of rare earths, you can't do it. So there's a tremendous incentive for the government, and particularly the legislation and the recent executive orders and National Energy Security Act, which also covers critical minerals, to accelerate and to assist the companies such as ours to get online and get it done now.
Harvey, suffice to say that the outcome will shape the future of global military power. As it stands now, how do you see this playing out? Who do you see leading? I mean, essentially, can the US and the rest of the world play catch up in a cost-effective way when it comes to rare earths and critical minerals?
The answer, in my opinion, is yes. Why? You have to. Two, the material is available. There are billions of dollars worth of rare earths in our case and in other supplies that we know of here in the United States. There's a growing desire to cooperate between the companies such as ourselves and others to fix this problem. And so while everybody is an entrepreneurial person and wants to do the best for their shareholders and their company, the reality is there is a stark realization of the problem as you've enunciated. And so there's more cooperation than you might suspect between the various companies, both in terms of processing and in terms of extraction. And the government is now assisting in making this happen, as opposed to making it difficult, where we used to talk about 20 years to bring a process on a mine online. It's now down, as I say, 2, 3,
right,
4 years. It has to be.
Harvey?
Yep.
You talked about how your company wants to expand production and capacity. How are you looking to fund that?
We are a private company, not a public company at this time. We are funded privately, and we are in discussions with multiple institutional investors who now understand that an investment in rare earths not only is patriotic, but it is also highly potentially rewarding because of all.
So no plans to IPO, Harvey?
We do. We've gotten multiple calls with various firms to do that. We are also working with our government, and we're working with other repositories of capital that have strategic desires to make rare earths available, et cetera. So our objective is that over the next 6 to 9 months, it's full speed ahead on execution. That's extraction of ore, fast-tracking permitting, working very fast and very closely.
Harvey?
Yes.
Might you IPO in the next 12 months?
I would say that is highly likely.
Harvey, thank you so much for your time today. Harvey Kaye, Executive Director at U.S. Critical Materials. Well, still ahead this hour, Jeffrey Gundlach is sounding a warning on the U.S. debt burden, telling us a reckoning is coming. Our exclusive conversation is next. Keep it here with us. This is Bloomberg. Welcome back. You're watching Insight. DoubleLine Capital CEO Jeffrey Gundlach believes Americans' debt burden and interest expenses have become untenable and may lead to investors to move out of dollar-based assets. He spoke to us exclusively at the Bloomberg Global Credit Forum in Los Angeles.
The reckoning is coming is that we have to somehow figure out how we're going to deal with $37 trillion. I mean, we're actually going to hit the 37 trillion number for real. It's still 36.95 trillion, but it's going up quickly. So yeah, there's going to have to be some pretty creative thinking, and the market's starting to believe that. So the previous group talked about capital flows, and one of the reasons that the U.S. is underperforming at this point is so much money came into the United States since, say, 2015 or so, or 2005. And there was a net investment position. Foreigners were investing more in the U.S. than the U.S. was investing outside the country, to the tune of $3 trillion. That was about 15, 17 years ago. It's now over $25 trillion is the net investment position. And the dollar is falling. So it's not inconceivable that some of that $25 trillion that came in over just a couple of, not even 2 decades, could go out. And so this is a moment where finally you have the setup where non-US investment, even if you're a dollar-based investor, you should be thinking about increasing your allocations to non-dollar investments. And it's already working. It's already working.
So there's so much to unpack there. I want to talk about the idea that there could be this 25 trillion or some of it that moves away from the US.
Trillion.
Right, exactly,
yeah.
Whatever it is,
yeah.
3 trillion. You're getting trillions of dollars moving out of US assets.
Yeah.
How high or what kind of behavior do you have to see in the 30-year bond to like it again, given the fact that you've been very vocal
I've been thinking about this for a long time, and I've come to the idea that as the Fed eases, and when the economy really does weaken more, the Treasury rate will continue to go up at the long end. And so for now, we're very uninvolved in the long-term Treasury bond. But there will come a moment where you have to pivot, because there's going to be a response. And I've got many ideas of what that response might be, but one of the leading candidates would be quantitative easing. So you get to a point where the rate is so uncomfortably high. What is that number? I'm going to guess 6%, where they say this is going to be something that we're going to be running a $5 trillion budget deficit with all this bond issuance when we go into a recession. And so they'll pivot. I believe this is a sensible idea. There's other ideas too, but the leading candidate is they will announce quantitative easing.
All right, coming up, buyout talk is set to dominate today's Toyota Motor annual general meeting. The latest from Tokyo next. Keep it here with us. This is Bloomberg. Welcome back. You're watching Insight. Shares of Toyota Motor are in focus today as the company holds its annual general meeting. Chairman Akio Toyoda is expected to retain his board seat despite concerns over his role in a controversial group company takeover. For more on this, let's bring in Bloomberg senior editor Reed Stevenson in Tokyo. Reed, we know that lots of criticisms in the lead up to the AGM. What's the mood expected to be?
Well, I think the AGM is pretty much wrapped up at this point. And interestingly, a lot of questions around Toyota Industries did not come up. A lot of the talk was just about, sort of big vision type stuff for the Toyota Group. But really, that's in contrast to the Toyota Industries AGM that we saw 2 days ago, where there was indeed a lot of questions, a lot of criticism even over the price at which, the Toyota Group is trying to take Toyota Industries private. And, those questions are going to continue, whether it's a shareholder meeting or not, in the coming months until this formal tender offer is launched in December.
Of course, Toyota's re-election is also a point of contention here, but no matter the criticism, he is getting his seat back.
Indeed. I mean, first of all, he carries the Toyota family name. But what you did see in the past few years is a slight sort of downtick in his reappointment vote rate. And especially last year, when a lot of issues around certification caused proxy advisory firms to recommend voting against him, they've kind of withdrawn that and now endorse him this year. So what we're expecting, and the numbers actually come out in a day or two, what we're expecting is actually a slight uptick in those numbers, which I'm sure is gratifying. But on the other hand, is that enough to remove a lot of this sort of talk and criticism around Toyota Industries, especially by investors who feel that the price is too low? I'm not so sure about that.
We talk about the future of Toyota. We have to talk about EVs. Where is Toyota on that?
I mean, Akio Toyoda, the chairman and grandson of the founder, is, really the face of Toyota's strategy here. And what he's adopted is something called the multi-path approach, which is to make sure every customer in every market has an option to buy combustible engine vehicles, hybrid vehicles, and EVs. And, Toyota and Akio Toyoda himself has been criticized for kind of slow walking towards EVs. But, he's been proven right in many ways, because a lot of the car makers that rushed into EVs got burned badly and are now kind of slowing down their strategy. Toyota, on the other hand, by taking this sort of measured multi-path approach, is going to have EVs in markets where there's going to be demand. For example, one of its new models in China has really done well in terms of orders, and they do have very concrete plans for the U.S. market, as well as the sort of infrastructure, the battery manufacturing, the actual manufacturing of a vehicle design to kind of have an answer for that. Of course, it all lies in the execution and implementation, and we're just going to have to see if that materializes in the coming years and decades.
Reed, great insights. Bloomberg senior editor Reed Stevenson in Tokyo. So as Toyota fine-tunes its EV strategy, a survey by Bloomberg Intelligence has found that over 64% of Chinese car buyers are opting for new energy vehicles versus 57% last year, mainly driven by a preference for plug-in hybrids. For more, let's bring in Bloomberg Intelligence China auto analyst Joanna Chen in Hong Kong. Joanna, what are some of the key takeaways from the China car buyer survey?
Thanks. So our car buyer survey basically serves as a lead indicator to track how consumer preferences and also trends evolving across the markets. We do it in China, and Japan, US, and Europe. So basically, from our latest China auto survey, we are seeing numbers trending up for new energy vehicles, 64% versus 57% last year of respondents saying that they wanted to choose new energy vehicles for their next car. But if we break the numbers down, and actually battery electric vehicles, of course, they're still taking the lead over like about 1/3 of survey respondents saying that they want a battery electric vehicle, but that's basically flatline versus our survey results last year. So what's really driving the higher consumer interest in NEVs is actually the plug-in hybrids, because the technology is developing really fast in terms of ultra-fast charging, but infrastructure will take time and resources, and until that is ramped up, consumers, they are still having some concerns about charging and battery performances. So in the near term, as we see that battery electrics and also plug-in hybrids, they're going to coexist in the market, and automakers which have a strong and also balanced portfolio in both BEVs and plug-in hybrids, they are best positioned for long-term market share gains.
Joanna, it is a highly competitive space, and we see from the screen where you are that BYD is leading the charge. Talk to us about why it is so and how the competition is likely to play out.
Yeah, we see rankings reshuffle when we ask the survey respondents what are the brands you are most likely to choose for your next car. In general, the homegrown Chinese brands are gaining ground versus foreign brands doing a retreat. And we see that BYD this year climbed to #1 and Tesla slid to #2. And what's really surprised, or maybe it's different from the last year result, is that Xiaomi, the new upstart in EVs, its ranking climbs so fast in the chart. And, the votes are only marginally below BMW to rank #4 in this year's, rankings. And we definitely see that this kind of brand popularity is not yet fully reflected in Xiaomi's sales numbers. People are waiting 11 months to get their Xiaomi car delivered. And the sales numbers are capped by production capacity bottlenecks. So when Xiaomi ramps up its second factory and also with the new SUV kicking in this summer, we definitely see that with this brand popularity, Xiaomi is a very strong contender in China's EV market, and that will pose a lot of threat on the existing EV players.
More than 2 years of price wars. What's the damage on branding, and how can EV makers boost their product appeal?
Yes, so the price war has been ongoing for more than 2 years, and that's really hurt the brand loyalty. More and more consumers, according to our survey, saying that they don't really have a preference in terms of brand choices, or they are pretty likely to jump to another brand versus their current car. And it's mostly because the branding doesn't really come into that much matter anymore. It's all about the product competitiveness itself. And automakers need to get the products right with right pricing, specs, and also the software offerings to really attract the consumers, because they don't care that much about branding anymore.
Joanna, thank you so much for that. Bloomberg Intelligence China auto analyst Joanna Chen in Hong Kong. Now, still ahead, we'll get insights on the Indian market with Kotak Mahindra Bank President Gautami Gavankar. That's as DoubleLine Capital's Jeffrey Gundlach calls the country one of the most bankable long-term investment opportunities. Keep it here with us. This is Bloomberg.
Is this a United States problem, or is this a global problem? Can you hide by going to invest in places like, say, Europe or Japan?
You can hide to a certain extent. I don't think you could become immune. I think the way to invest in periods like this, I think, are to go with long-term themes. And a long-term theme that I think is one of the most bankable, and it might take, in 30 years, this will be a great success, and that is you should invest in India, because India has a similar profile today to where China was 35 years ago, when they had tremendous population, labor force, visibility of labor force growth, tremendous problems, a gummed up legal system, corruption all over the place. But those are things that can be fixed. And you see, but China went from 1/12 of the U.S. GDP to 70–80% of U.S. GDP, and they certainly produce more goods than the United States, so in a certain sense, they're bigger. Well, India has the same demographic outlook as China did then, and India has a benefit for supply chain being moved around, for manufacturing can come there. They're very technology. They have a long history of being, a significant society. So I don't know how long it's going to take, but that's one that you buy, and you just do yourself a favor and don't open the statement, Because if you do, when there's trouble, you're going to sell it, right? Because it'll be down 30%. So just hold it for your grandchildren's college fund.
DoubleLine Group CEO and CIO Jeffrey Gundlach speaking to Bloomberg's Lisa Abramovich at the Bloomberg Global Credit Forum in Los Angeles. She says India is a good long-term bet for investors looking to de-dollarize. Well, joining us now, Gautami Gavankar, president at Kotak Mahindra Bank. Gautami, does it feel like India trumps China right now, especially when it comes to the wealthy individuals, when it comes to family offices? What's the trend?
Thank you, Haslinda, for having me on Bloomberg. Very, very apt question. India is the fastest growing economy today, and we see a lot of traction in the UHNI, HNI space in India. We have seen the growth in this space in a tremendous way. We feel that because of the Indian demographics, because of the technology story, because of the consumer-led demand, because of the financialization, there is going to be a tremendous growth that we will see in India. And we see us tracking on the emerging markets also high up there. And thus we feel that India will do definitely way better. And we keep ourselves exceeding at all the actions that we take.
Is it also a case of India being seen as a safe haven given the US-China trade tensions? And what kind of exposure to India are investors looking at?
So if you consider the interest in India, as I indicated, that there's a lot of growth story in India. We see the family offices rising a lot in India. But when you come to non-resident Indians or foreigners or institutional investors looking at India, we see that also growing. I don't want to get into a comment on the political dimensions of India-US trade treaties. Having said that, the political parties and our government is doing all it can do to ensure that we get a benefit to the extent we deserve it. Having again said that, between the emerging markets, I think we really stand to gain a lot. And we see that happening all across in our markets, be it equity markets, be it debt markets, or be it the alternate space that India is really growing in.
But isn't it true that now investors are increasingly staying away from equity and debt market, looking more into the alternatives in India?
So I think the top of the pyramid report, which Kotak itself came out with, clearly said that equity is the king, and we still believe equity markets are where a lot of people have an interest in. Alternates do get a big space now because in equity markets do really well. The alternative investments also are looked at to see if we can get a higher returns by investing into alternates. Alternates like real estate funds, private equity funds, private credit funds, special situations fund, all are something which a lot of clients are looking at investing in. We see a lot of globalization also happening. We see our clients investing and diversifying their portfolios into global investments as well.
The alternative market is interesting. People talk about how it will grow fivefold by 2034, set to be, what, $2-3 trillion market. I'm just wondering, how do you play this market? How should you position? Is it in real estate, like you mentioned, or could there be other sectors to play in?
So definitely it has to be a mix of all the sectors that one looks at. One cannot only concentrate on real estate as a sector. So there are two ways to look at it. One is how the resident Indian is playing the market. They are definitely playing it by, if it's real estate play, then it's looking at REITs and InvITs. These are the structures which get created and people do invest in that. We see a lot of growth in private credit for the domestic markets as well. We see a lot happening in the life sciences fund. We ourselves have launched a life sciences fund for clients. But when you look at money coming into India from an offshore territory, we look at two options. One is an ability to invest into rupees, and the other is an ability to invest through dollars. So we are creating feeder structures through offshore locations, offshore territories, to feed into the Indian feeder funds, so that even a foreign citizen, a non-resident Indian, a foreign institutional investor can play through the feeder structures.
You've got to wonder how attractive India can be to foreign investors. We spoke to Gundlach earlier this year, and he talked about being concerned of the tax on capital gains. That makes India unattractive, he says. What's your take on that?
I think it's something which we need to look at from a government's perspective. We've seen a lot of tax reforms that we have had in India. We have seen this budget's ensuring that there were tax cuts done for the affluent Indian, and from that perspective, there's a lot of savings which an Indian will do, and that will deploy into consumers and financial industry, and thus it is not appropriate statement that the tax reforms are not done. Very clearly, the government has taken a lot of efforts to ensure that tax reforms have been done. There are tax treaties which have been signed, whereby the agreements give us benefit when a foreigner or a non-resident Indian is investing into India. We don't have things like some tax regimes like inheritance tax regime or gift tax regimes which are prevalent in other countries, and thus investing into financial markets makes it easier even for a non-resident Indian.
It is a lower rate environment. The RBI surprised with a 50 basis point cut recently, and more cuts are expected in the coming quarters. Is that shaping investor thinking and strategy?
Absolutely. I think the RBI's bold move of cutting the rates is going to increase liquidity in the market. Very clearly, that's going to help us grow. We saw the markets going up as well on the day the RBI cuts happened, and we think that it will go overall in the benefit of the Indian clients and the markets. The move that RBI has taken, we kind of think that this has been done to ensure that the sentiments are right and the markets also see a lot of liquidity and the market uptick happens.
What kind of returns do you think investors can get from the Indian market?
So, Haslinda, this is a very generic question. What I would like to say is typically it should be looked at from an asset allocation driven perspective, depending upon whether the client is investing into equity, debt, or alternates. And if asset allocation model is followed, then the returns will depend upon the kind of asset that one has invested in. We urge our clients at Kotak to ensure that they follow an asset allocation. Equity anywhere in the range of 12 to 15%. Debt could be less than 10%. Alternates could be anywhere depending upon the asset class that you invest into and the fund performance. For alternates, you may have to wait for a while because that's not a very liquid asset class.
People have been talking a lot about the gift city as well. Just wondering how you see that as an investment vehicle.
So, yeah, excellent question again. Gift City has been very beneficial for us Indians and also for foreign institutional investors or non-resident Indians to come into India. It's something which we all have looked up to for creating structures, for being able to assist our clients in using a larger limit than what is permitted under liberalized remittance scheme. In fact, the most beneficial has been when non-resident Indians want to come into India through the Gift City feeders. The regulatory regime there, the regulator there, the rules and regulations which allow you to create structures are very well drafted, and thus it becomes extremely easy for one to create structures there and get money into India. We see a lot of growth in the Gift City structures and the Gift City usage by Indian clients and by non-resident Indian clients. And we at Kotak are also having a lot of structures created through Gift City.
You talk about anticipating a lot of growth. Can you elaborate on that?
So I'll just explain one principle when a resident Indian is investing outside India. Through the Gift City route, resident Indian who has an entity in India, like a company or an LLP or a partnership firm, he's entitled to take outside India 50% of the net worth of that Indian company, which is called the OPI, or the Overseas Portfolio Investment Route. Thereby, the limit growing much beyond the liberalized remittance scheme, which is today restricted to $250,000. So that itself enables an Indian family office or an HNI or a UHNI to be able to diversify their assets using the gift city route of OPI. And thus I feel, and thus the industry feels, that the gift city will enable us to grow the diversification into dollar assets in a much larger way. Similarly, when you see money coming into India, because we look at both options, one is India to globe, which is what I spoke about, OPI and the LRS, and the other is globe to India. Even in that context, it is important to understand that the gift city route today allows a complete NRI structure to be created and invested into India. That helps us to kind of have a vehicle created which is fully subscribed by non-resident Indians. A lot of family offices, a lot of fund houses are trying to deploy money into India using these structures and the gift city route.
Right. Gautami, before we let you go, just one final question. Even as you express optimism about the Indian market, all eyes are on negotiations between the US and India for trade. A lot is at stake for the economy. How are you assessing the risk from that?
So I think India has a lot of its own demographic play and the consumer play. Keeping that in mind and the ability to do kind of manufacturing that we can do in India, the trade treaties will definitely be important. The government, I think, is doing all it can to ensure that India gets its due share. And I think beyond what the government will do and ensure that it is done for the benefit of India, at this stage, we are very optimistic and bullish about the Indian economy.
Gautami, great to have you with us. Gautami Gavankar, President at Kotak Mahindra Bank. India's been trading for nearly 10 minutes now. Let's do a check on how Maruti Suzuki is doing. We've had some lines coming out of the company saying that Maruti Suzuki is saying that the magnet issue is not really causing problems to it. It says that the rare earth magnet issue, there's lots of uncertainty when it comes to that. No operations disruption due to the rare earth shortage. Maruti Suzuki currently trading up at this point in time, currently trading up by about 19% as we speak at this point in time. Maruti Suzuki currently actually up by 0.1%. Suzuki Motor down by 1.2%. Let's take a look at how India is trading right now in the first 10 minutes of trade. It is trading pretty much in positive territory, just a tad, up 0.1%. That is it for Insight. Horizons Middle East and Africa is next. Keep it here with us. This is Bloomberg.